With property prices softening, is it time to buy rather than be in the rental market? In this video, we're going to be discussing the pros and cons of renting versus buying your own home. And we're going to discuss Emily and I's original strategy and how we've adopted and changed our strategy over time to meet our situation and to fit our family circumstances. Now, the media cycle has been strong on property price declines over the last few months with the increased interest rates, and the market is going into a bearish phase at this point in time. But this can also breed opportunity for those who are paying rent and have seen significant rental increases. This could mean that it's actually cheaper to buy a property and move into the home and pay off the mortgage. So is rent money dead money, or should you be a rentvestor and put your hard-earned cash into other investment properties? Emily and I have talked about this multiple times over the last 5 or 6 years. When we first started building our property portfolio, we were weighing up this exact question. Should we try and buy a starter home? Should we go for the dream home or location? Or should we continue to rent and just buy investment properties and build our asset base? Now, for a lot of YouTubers and investors, rent vesting has been the strategy that has allowed them to acquire a large number of assets as they started to grow their property portfolio, rather than getting that dream home or that big rock in the jar to set themselves up for a family home. And you need to weigh up this for yourself as an individual or as a couple. So Emily and I actually rented, and we paid quite a cheap amount of rent. Back when we first got married, we spent $320 a week for a pretty rough, pokey apartment in Holland Park. Now, it wasn't the nicest place. It had timber floors and very thin walls, and it didn't have a whole lot of room, but we tried to pay as little money as possible on our rent so we could build our savings up to buy our first home. So some of the pros of renting is that it has that lower upfront cost. For $300 to $700 a week, you can find a decent property, whether it's an apartment or a house here in Southeast Queensland, and have quite a nice place to stay. Now, going back to Emily and I's situation, we made sure we really reduced it. We could have spent $400, $500, $600 a week when we first got married and put a lot of our take-home pay into a rental property. But we decided to pick a place that was a bit pokier, a bit rough around the edges, and save as much money as possible towards a deposit. Now, rent's probably the biggest thing that you can save money on, because $100 a week is $5,200 a year that could go towards a deposit. One of the great things about being a renter is there is minimal maintenance. You have an issue with a blind, you have an issue with the dishwasher, pick up the phone, call the property manager, say, hey, I'm sorry, something's broken, and the landlord will pay for that. Now, we tried to be reasonable when we were renters and fix lights ourselves and do little bits and pieces, but generally for bigger items, you can call the landlord or your property manager and get things fixed. So it means you don't have to cover the maintenance costs for that property. You also don't have to worry about property taxes, and you've got much greater flexibility. You could live in Brisbane, you could live down on the Gold Coast, you can move to Sydney, Melbourne. You can move around and be flexible if you don't have your own home that you're tied to. So being a renter or a rentvestor can be a great option. On the flip side, as you're starting out as a renter, there are some negatives. I mean, one of the flip sides is that flexibility can actually work against you. You might be really settled and enjoying your location, enjoying a home or an apartment, and then be told you need to move out. The owners are coming back in. They have different plans for this property. And so you could be in a great location, in a happy situation, and get the flick and get the boot and kicked out of that property. You're also, like we're now seeing, susceptible to rental increases. And in the Southeast Queensland market, rents have gone up 50, 80, $150 a week on the high side. And so these rental increases can come thick and fast year to year, and you essentially have to stump up the cash if you want to stay in the same place. So there are definitely pros and cons to being a renter, but the biggest negative that I see is the lack of equity building in your favor. Now, in my opinion, the property market will increase slowly over the long term. As an example, I use in my calculations, say 5 to 6% long-term capital growth. Now, renters don't get exposure to this long-term equity and long-term capital growth. So if you're just renting for your entire life and you don't buy any assets, then how are you going to see market appreciation? You're relying on your ability to save and your savings to keep up with inflation and allow you to cover your costs well into your retirement. I would much rather have exposure to assets like property, like shares and bonds if you're very conservative. Having exposure to these types of assets means you're going to lift with the market and create equity. To close out on the rental side, you can build up deposits and spend less cash on your own home and use that money to buy property. So what are the pros of buying property? They almost act as the inverse of the rental pros and cons. So some of the pros are that you get that equity build up, you have a lot more control over your property. You can manufacture value, you can flick tenants, you can talk to town planners and get a DA over that property. There's a lot more options when you control that asset and you can choose what to do, whether it's short-term or long-term accommodation, whether you're charging market rent or you want to push the rental prices, it's up to you at the end of the day. Now, I generally try to charge fair market value for our rental properties. We have seen our rents increase in our property portfolio, but we've also seen interest rate rises on our debt. And so you've got to try and find the balance when you become a homeowner or a landlord. Now, I don't really like the term landlord because that means you're ruling over other people. I much prefer steward or stewardship. So if you're stewarding a property and garnering this asset base, it's important to understand those numbers intimately and to charge fair market value and not undersell yourself as you build out this portfolio because you're running it like a business at the end of the day. Some of the negatives of buying your own home or using funds to buy an investment property is the much higher upfront costs. Generally, you're going to need $40,000 plus to buy your first property here in Australia. You're going to need to cover stamp duty, legal fees, other costs, building and pest. So you need to build up cash and be prepared to spend a lot of cash to actually get into your first property. We can see as high as 5 or 6% of the purchase price chewed up in those upfront costs and fees. You also need to be wary of the ongoing costs, so the maintenance, the repairs, and the exposure to interest rates. These costs can really hurt you depending on the price point of a property. If you have $1 million home and a $500,000 property, and they're both investments, if they break a light or the front door gets kicked in or whatever goes on in that property and you need to cover the maintenance, that can really hurt the cash flow on a particular property. If you have a really high maintenance expenditure in a certain year, that can eat away at your cash flow significantly. You might be getting, say, a 6 or a 7 or even an 8% gross yield, but if you have a hot water tank blow or you have the blinds pulled down by the tenant or the dishwasher busts and the oven blows at the same time, then you could be up for thousands of dollars coming out of your cash flow. So you need to be wary of this and run your numbers diligently when you're looking at your own home or an investment purchase. One of the final key points is taxes. Now, you've got those upfront costs that we spoke about, but you've also got ongoing costs if you build an asset base. This could be income taxes if you're earning a high amount of passive income from your property portfolio, capital gains taxes if you're exiting out of developments or certain property projects, and you've also got land tax, which you need to be careful of in structuring your portfolio in a diligent way. And you then have the fees associated with tax accountants, trust structures, company and trust structures, if you're structuring yourself correctly. So you need to be aware that it is quite an expensive environment in terms of managing those taxes and making sure you're paying your taxes, but also looking to minimize your taxes in a very legal way, of course. So based on all of the pros and cons that we're seeing, maybe buying a property at this point in time with the much higher interest rates and the rental increases could be the right option for you. On the flip side, if you're happy living in a share house and you're paying very cheap rent, or you're living with mum and dad, or you've got the opportunity to pay lower rent and you can use your funds and use your borrowing capacity to build an asset base and build a property portfolio, that's exactly what Emily and I were looking to do when we started out. Our original plan was to be rent investors for that specific reason. And the reasons were that we could build our cash savings, pay a minimal amount of rent, and also use our maximum serviceability and leverage to build our asset base and portfolio. Now, things change over time, and it doesn't always play out this way. Emily and I had those fantastic plans. We were going to be rent investors. We were going to build our $5 million, $3 million, $5 million, the goals keep changing, $10 million property portfolio and build our passive income to $120,000. Now, we did end up buying our own home, and we do see this as an investment. So your strategy can change over time. The reason we bought the triple Gable Queenslander is we saw opportunity. And you might see this as a homeowner. If you're seeing your money go to waste as a renter and you want to get into your own home and you can see it as an investment as well, that's where you might want to dive in. So Emily and I did exactly that. We saw the triple Gable Queenslander. We went, look at this beautiful home. It's character overlay. It has great manufactured value potential, both in the short and long term. Because when we first bought the property, we spent about $50,000 updating and upgrading the home, and it got revalued at several $100,000 more. Now, that wasn't just the renovations. The market was increasing in value significantly over that time too. But between the manufactured value and the market growth, we were able to pull out several $100,000 worth of equity and buy the unit block in Coffs Harbour. So without those steps, we wouldn't have been able to continue to grow our property portfolio. So we really do see this asset as part of our portfolio, just with $0 of rental income associated with it. We also have a stage 2 for this property, which is really sweetening the deal. And that is our plans to raise and build in underneath this home. Now, this is our dream home and dream location. We're in a dead-end street. We're in a suburb that we love, and we're creating our family here for the long term. So we want more bedrooms and bathrooms. I want a studio to create these videos and have conversations and create more content online. And so Emily and I have got the plans. We even added a pool in our future plans because Asa loves swimming. Emily and I would love having a pool. And so we created some lifestyle, and we're going to spend more money on building this home. But I also see it as an investment. If we spend $300,000 to $400,000 doing our raise and build project, we could potentially create another $300,000 or $400,000 of equity. And then we could use that equity to draw that equity out and take those funds and buy another investment. So there's nothing stopping you starting out as a rent investor and then buying your own home once you want that big rock in the jar, but also wear your investment cap when you're making that purchase decision. I'm really excited to be sharing the series on our Triple Gable Queenslander as we go from our original renovations into the raise and build project. If you're interested in seeing Emily and I chat through the plans and what we're doing with this property as we look to add more bedrooms and bathrooms and add more value, then make sure you click this video over here. If you're looking to buy a property in Southeast Queensland in the next 6 to 12 months and you want to have a chat with myself, head over to purposeproperty.com.au to book in a free strategy session. I'll see you in the next one. Peace.